Imagine, like your nosy neighbor, or maybe even your biggest business competitor, just casually strolling into the local BIR office.
Oh, wow. Okay, starting with a horror story.
Right. I mean, they walk right up to the counter, slap their hand on the desk, and say, uh, I would like to inspect the complete income tax return of, and then they just drop your name.
That is exactly the kind of nightmare scenario the examiners love.
Yeah, because they want to see, every deduction, every single peso of gross income, basically your entire financial life laid bare. And according to the Philippine Tax Code, your tax return is legally classified as a public record.
It is, which is wild to think about.
It's totally wild. So the question is, can the clerk just, hand it over?
See, it feels like the answer should be a simple yes or no, but it's actually a massive trap.
And navigating those traps is exactly why we're here today. So welcome to ICPA Review Radio.
Glad to be here, as always.
If you're tuning in, you are likely a determined CPA board exam candidate, probably fueled by, I don't know, copious amounts of coffee and sheer willpower at this point, right?
Yeah. Oh, yeah, lots of coffee. And probably running on very little sleep.
Exactly. You are getting ready to conquer the licensure exam.
Yeah.
And today's review session is a deep dive into sections 67 through 73 of the Philippine Tax Code.
Yeah, and these specific sections, they really serve as this fascinating bridge in the law.
How so?
Well, on one side, you have the raw mechanics of tax administration, right? Like literally how the Bureau of Internal Revenue gathers its intelligence, how they track the money.
The enforcement side of things.
Exactly. And then on the other side, the law transitions into hardcore corporate taxation, specifically the mechanics of how corporate wealth is distributed and taxed.
Okay, let's translate this into exam strategy for the candidate listening right now. Why does this specific block of the tax code matter so much to them?
It matters because board examiners leverage these sections to touch two completely different skill sets.
Okay, break that down for us.
Sure. So the first half, which covers the information return rules, that's a frequent target for those incredibly tricky, highly nuanced true or false theory questions.
Ah, the ones that make you second-guess everything you've ever learned.
Exactly. They are testing your reading comprehension and your memory of like very specific exceptions. But then the second half, which covers the rules on corporate distributions and dividends.
Let me guess. Computations.
Heavy computations. It's an absolute heavyweight for computational multiple choice questions. I mean, you are guaranteed to see these concepts on exam day.
Okay, so our mission for this deep dive is to decode those reporting requirements, help you navigate what we just called the public records trap, and really master the exact timing and nature of taxable dividends so you can snatch every possible point.
Snatch every point. I love that.
Let's start at the very beginning of the income life cycle then. Because before the BIR can actually assess a tax, they kind of have to find the income first, right?
Right. They can't tax what they can't see.
And looking at the source material,
Yeah.
it feels like the government is basically, I don't know, crowdsourcing tax audits.
That's a really good way to put it. They're essentially building an intelligence network.
Like a financial neighborhood watch.
Yeah, exactly. Because to assess a tax accurately, they need this vast, interconnected web of data. And the law kicks this off by targeting foreign money first.
Okay, so Section 67.
Right. Section 67. Under this section, if you or a corporation or a partnership are in the business of collecting foreign payments of interest or dividends.
Like via coupons or checks or whatever.
Yeah, coupons, checks, bills of exchange. If you're collecting those for profit, you are legally required to obtain a license from the commissioner.
Wait, a literal license? Just to collect a foreign dividend check for profit?
A literal license.
That feels like a lot of red tape just to process international payments.
I mean, it is a lot of red tape, definitely. But think about the BIR's objective here. They're trying to maintain a chokehold on international cash inflows.
Because it's hard to track otherwise.
Extremely hard. Offshore passive income is notoriously difficult for a domestic tax authority to keep tabs on.
So they just force the issue.
Right. By forcing anyone in the business of collecting those foreign payments to get a license, the BIR basically creates a mandatory checkpoint. They are identifying the gatekeepers.
Okay, that makes sense from an enforcement perspective. Find the gatekeepers, find the money.
Exactly.
But the domestic side of this intelligence network is what really jumped out at me in the source material.
Oh, Section 68, information at source.
Yes, Section 68. It says that if you pay rents, salaries, wages, or what the law vaguely calls other fixed or determinable gains, you have to submit a true and accurate return to the commissioner.
And you have to detail the exact amount paid, plus the recipient's name and address.
So it's basically the BIR deputizing you to report on your peers.
Deputizing is the perfect word. They are building a massive database to cross-reference against the income tax returns filed by those exact recipients.
I see where you're going with the cross-referencing, but let me push back on the scope of this for a second.
So go ahead.
If I am a massive multinational corporation paying out like 5,000 salaries, I totally understand the reporting burden.
Right.
But what if I'm just a regular lessee? Like I'm just renting a small commercial office space from a local landlord?
Yeah.
And I seriously supposed to report my landlord's rental income to the government?
Yes, you absolutely are.
Really? Even for a small office?
Even for small office, the law explicitly applies to all persons making these payments. Let's call it the informant rule.
The informant rule. That sounds so sinister.
It kind of is, but examiners will try to trick you by offering a multiple-choice question that states only corporations and employers are required to file information returns regarding income payments.
And that sounds completely reasonable from an administrative standpoint, honestly.
Which is exactly why candidates fall for it. It sounds logical, but it's completely wrong.
So if an exam choice limits this reporting duty strictly to big businesses, I should just flag it as false immediately.
Without hesitation, mark it false. The tax code specifically lists lessees, mortgagors, trustees, executors, administrators, and receivers.
That's a huge net.
It even includes government officers. If an officer of the Philippine government has information as to such payments, they are also required to make these returns. The informant rule spares no one.
Okay, wow. So we've got gatekeepers for foreign money and the informant rule for domestic payments like rent and salaries.
Yep.
But the law goes one step further, right? It specifically targets brokers under Section 69. Why single out brokers?
Because you have to follow the invisible money.
Invisible money.
Yeah, think about it. Stock and commodity trades happen entirely on paper, or, well, digitally now. They happen rapidly and often in massive volumes.
Through thousands of trades a second.
Right. So the BIR cannot practically track every single buy and sell order executed in the market, but the broker holds the master ledger.
So they just go to the source of the ledger.
Exactly. The commissioner can require a broker to render a correct return under oath, essentially handing over their clients' names alongside the granular details of their profits and losses.
So if a client makes like 1 million pesos day trading, the BIR finds out because the broker is forced to tell them.
Yep. There's nowhere to hide it.
So we have this massive, sweeping intelligence gathering operation domestically, but capital's incredibly fluid. It crosses borders effortlessly.
Especially these days.
Right. So how does the law handle international maneuvers? Like where a taxpayer might try to move assets out of the country to hide them from this whole domestic network.
That brings us directly to the formation of foreign corporations under Section 70.
Okay, what does Section 70 do?
Well, the government knows that restructuring overseas is a classic strategy for tax avoidance. To combat this, the law dictates that any attorney, accountant, fiduciary, bank, or financial institution who aids, assists, counsels, or advises in the formation or reorganization of a foreign corporation.
They have to file an information return too.
They absolutely do.
Basically, if you help someone set up an offshore shell company, you have to tattle on them.
That's the blunt way to say it, yeah.
And looking at my notes, there is a very strict deadline attached to this, isn't there?
30 days. If you are listening, write that down in big letters right now.
30 days.
You must file the return within 30 days of providing that aid or counsel.
30 days is an incredibly tight window. I mean, why not just let them report it at the end of the taxable year like almost everything else?
Because capital flight happens in the blink of an eye.
Oh, right. The money moves fast.
Super fast. If the BIR waits until the end of the year to find out a taxpayer moved assets into a newly formed foreign corporation, the money and the shell company might have already vanished into a completely different jurisdiction.
So it's an early warning system.
It's a tripwire. The 30-day rule is a tripwire. If an exam question says 60 days, or, by the 15th day of the 4th month following the close of the taxable year, it is dead wrong.
Okay, 30-day tripwire. Got it. But wait, this law explicitly includes attorneys.
It does.
What happens to attorney-client privilege? Like, can the BIR really force a lawyer to break confidentiality just because they gave tax advice on a foreign merger?
That is the crucial caveat the examiners will test.
Because that seems like a huge violation of legal ethics.
It would be, which is why the law explicitly protects attorney-client privilege.
Oh, okay. Phew.
Yeah, you must report the objective fact that you aided in the formation of the foreign core. But nothing in Section 70 forces an attorney to divulge privileged communications.
So the fact of the representation isn't privilege, but the actual legal strategy discussed behind closed doors remains protected.
Precisely. You just have to say, hey, I helped set this up. You don't have to hand over their strategic playbook.
That is a relief. Okay, now, I want to circle back to the scenario we opened the show with,
The nosy neighbor.
the nosy neighbor. Because we've established that the BIR is hoarding a terrifying amount of data about every citizen, right? And under Section 71, an assessed tax return literally constitutes a public record.
It does say that in the text.
So let's resolve the cliffhanger for the listener. Can my nosy neighbor just walk in and inspect my tax return?
The clerk at the BIR is going to laugh your neighbor right out of the building.
Thank goodness.
Yeah. Yes, returns are legally classified as public records, but they are practically locked inside a vault. They are only open to inspection upon the direct order of the President of the Philippines.
The actual president, like the chief executive of the country, has to sign off on someone looking at my tax return.
The actual president, not your neighbor, not a journalist, and not even upon the BIR commissioner's independent whim. It requires a presidential order.
Wow, that is a massive distinction.
And the board examiners will test this exact nuance. They will offer a distractor choice, claiming returns are open to inspection, like upon a request by any citizen or upon the order of the Commissioner of Internal Revenue.
And you have to recognize those as false immediately.
Exactly.
But what about international tax treaties? The Philippines regularly exchanges information with foreign tax authorities, right?
They do, yeah.
So if, say, the IRS in the United States asks for information on a dual citizen under a treaty, does the BIR just hand that over?
It is still locked down. Even if a taxpayer is the subject of a valid request for an exchange of information by a foreign tax authority under an international convention, opening those specific income tax returns for inspection still requires the order of the President of the Philippines.
So it's a public record in name only. It's completely inaccessible without the highest executive clearance in the land.
Pretty much.
All right, before we transition into the corporate taxation side, there's one more administrative enforcement rule we need to dissect.
Section 72. Suits to recover taxes based on false or fraudulent returns.
Right, so the underlying logic here seems straightforward, but the consequence is severe.
Very severe. Let's say you file a return containing an understatement of income. The BIR catches it, flags it as false or fraudulent, makes an assessment, and collects the tax. The rule states you cannot turn around and sue the government to recover that collected tax unless you can definitively prove that your return was not false or fraudulent.
So the burden of proof completely shifts to the taxpayer to clear their name first.
Exactly. You can't just pay the penalty and then sue on some minor procedural technicality later.
You have to prove you weren't committing fraud. But there is a glaring exception buried in this section.
Yes, and it is oddly specific, which makes it prime material for a theory question.
Oddly specific is an understatement.
Right. The harsh rule we just discussed does not apply to statements or returns made in good faith regarding the annual depreciation of oil or gas wells and mines.
Oil and gas wells and mines. Why is the Philippine tax code giving a special break specifically to the mining and drilling industry?
It's all because of the unpredictable nature of geology.
Geology.
Yeah. Imagine you are a mining engineer trying to estimate the exact depreciation or depletion of a subterranean gold vein. It is a highly technical guessing game based on surveys and core samples.
So it's not an exact science.
Not at all. You might estimate a 10-year lifespan for the mine, but it runs dry in 5. If a mining company makes a genuine good faith estimate of their depreciation, that turns out to be wrong.
Which would result in an undervaluation of income.
Exactly. The law recognizes it wasn't malicious fraud, it's just the messy reality of digging into the earth.
That actually makes perfect sense when you put it like that. So for the listener, the mental trigger you need for exam day is good faith, depreciation, mines.
Yes.
If you see those words, you've found the exception to the fraudulent return rule.
That is the exact mental trigger you need.
Awesome. So the BIR gathers all this intelligence to track where the wealth is. Now let's look at how that wealth is actually distributed to shareholders.
Which is where the computational heavy lifting happens on the exam.
Right. We are diving into corporate distributions, section 73.
Get your mental calculators ready. First, we need to clearly define a dividend. Under Section 73A, a dividend is any distribution made by a corporation to its shareholders out of its earnings or profits.
Okay, pretty standard.
And it can be paid in cash, or it can be payable in other property.
The section also mentions complete liquidations. If a corporation just completely dissolves and hands all its remaining assets back to the stockholders, how is that treated?
Well, when a complete liquidation happens, the stockholder is essentially surrendering their shares in exchange for the underlying assets of the company.
So it's like a trade.
Exactly. Because of that dynamic, the gain realized or the loss sustained by the stockholder is treated as taxable income or a deductible loss, just as if they had sold the shares to a third party.
Okay, so liquidations are treated like a sale or exchange. Easy enough. Yeah. But let's get to the concept examiners absolutely love to test.
Stock dividends under Section 73B.
Yes. The general rule is simple enough, right? A stock dividend where a company just transfers surpluses into the capital account and issues more shares to existing stockholders is not subject to tax.
That is the general rule, yes. But you and I both know the exam won't stop at the general rule.
You never do. I have seen a very specific scenario in practice materials repeatedly.
Let's hear it.
Okay, so a corporation declares a stock dividend, which we just said is exempt. But the very next sentence in the problem states that the corporation immediately redeems or cancels those newly issued shares in exchange for cash.
Yes. The classic maneuver.
When I read that, it feels like a magic trick. I mean, they're handing out cash to the shareholders, but trying to disguise it by funneling it through a stock dividend first.
It is absolutely a magic trick. It's an illusion designed entirely to avoid taxation, but the tax code is specifically designed to pierce that illusion.
Okay, so how do we handle this on the exam?
Let's walk through the mechanics of this step by step, just as you would approach it in a live computational problem.
Okay, I'm ready.
Step 1. A corporation has excess earnings. They issue a stock dividend. Let's visualize this. The corporation is a pie.
I like pie.
They just cut the pie into more slices. At this exact moment, has any real wealth left the corporation?
No. I mean, the pie itself hasn't changed size. I might hold more physical shares of stock in my hand, but my proportionate ownership of the company's total value is exactly the same as it was yesterday.
Precisely. Because no actual wealth was realized by the shareholder, there is no tax.
Right.
But now we move to step 2. The corporation turns around, takes cash out of its vault, and buys those exact shares back from you, canceling them. What is the economic reality of what just happened?
The economic reality is that they just handed me cash out of their earnings. The extra slices of pie are gone, my percentage of ownership is right back to where it started, but now my wallet is heavier.
And that is the exact logic the BIR applies.
Really?
Yes. The rule under Section 73B states, if the cancellation or redemption of a stock dividend occurs at such time and in such manner as to make it, quote, essentially equivalent to the distribution of a taxable dividend.
Oh, essentially equivalent.
Exactly. Then the amount distributed is considered taxable income to the extent of the earnings or profits.
So for the candidate listening, you need to actively scan the text of the word problem for that exact phrase, essentially equivalent.
Yes, or for any scenario that perfectly mimics a cash payout disguised as a stock redemption.
Because the examiners are testing your understanding of substance over form.
Right. If the economic substance is a cash dividend, the BIR will tax it as a cash dividend regardless of the fancy paperwork.
That's a great way to remember it. So we understand the nature of a taxable dividend and we can spot the magic trick. But examiners are masters of misdirection.
They really are.
They're going to try to confuse the candidate on the timeline, aren't they? Like they want you to guess where the money came from and when it should be taxed.
Definitely. Which brings us to sections 73C and D. This covers timing and tracing.
Let's tackle tracing first under Section 73C. This dictates the source of dividends.
Right. When a corporation makes a distribution, the law doesn't let the company just pick and choose which year's profits they are paying out.
They can't just point to an old ledger.
No. The law presumes, it deems, that every distribution is made from the most recently accumulated profits or surplus.
Let me make sure I have this right. So if a company has retained earnings sitting in the bank from 2020, 2021, and 2025,
Okay.
and then in 2026, they decide to pay a cash dividend, the law forces them to trace that payout to the 2025 profits first.
That is correct. Think of it as LIFO for dividends. Last in, first out.
LIFO for dividends. I love that.
Yeah, the most recently accumulated profits are always the first ones pushed out the door to the shareholders. And crucially, those dividends constitute a part of the annual income of the distributee for the year in which they are actually received.
So write down LIFO for dividends, everyone. It will save you time on the exam. It's sticky. I like it.
It works. Okay, let's move to Section 73D. This deals with partnerships, but specifically partnerships that are subject to corporate income tax under Section 27A.
Okay, wait. Clarify that. We aren't talking about general professional partnerships here, right?
Yep. Exactly. General professional partnerships, like a firm of CPAs or a law firm, they're entirely different beasts. They are generally not subject to corporate tax.
Right.
Section 73D is targeting taxable partnerships, like a commercial trading partnership. And this right here is perhaps the biggest computational trap in the entire section.
Ooh, okay. Let's build a scenario. Walk me through the math. Let's say we have a taxable commercial partnership.
All right, let's say this taxable partnership earns a net income for the year. First, because they are subject to Section 27A, you must compute and deduct the corporate income tax imposed on the partnership entity itself.
Okay, so you pay the corporate tax first. Let's assume that after paying that, there is exactly 1 million pesos of net income left over in the partnership.
Okay, the partnership has 1 million pesos in the bank, clear of corporate tax.
So if I'm a 50% partner, do I pay tax on my 500,000 peso share right now? Or do I wait until the partnership actually writes me a check and distributes the cash?
If you wait for the check, you fail the exam question. Yeah, Section 73D states that the remaining taxable income of a partnership shall be deemed to have been actually or constructively received by the partners in the same taxable year.
Wait, so even if the partnership decides to reinvest that entire 1 million pesos into, say, buying new equipment, and they don't distribute a single centavo to the partners?
It does not matter.
Yeah.
The law forces the recognition of that income immediately. Your 500,000 peso share is added to your personal gross income for that year, and you are taxed on it in your individual capacity.
That's intense.
The magic phrase examiners use here is constructive receipt.
Constructive receipt. It's basically phantom income. You haven't seen the cash hit your personal bank account, but the BIR says, well, congratulations, you owe tax on this right now.
Exactly. It's a strict anti-avoidance measure. It prevents partners from just parking their money indefinitely inside the partnership entity to endlessly delay paying their individual income taxes.
So on the exam, if they ask you to compute the taxable income of partner A, and the problem explicitly notes that the partnership retained all its earnings for expansion and distributed zero cash.
Do not fall for the distractor choice that says the partner's taxable income is zero. You still compute partner A's proportionate share of that post-tax net income and add it to their personal tax liability.
The tax triggers the moment the partnership earns it, not when partner pockets it.
Exactly.
Man, this has been an incredibly dense, highly testable review session.
We covered a lot of ground today.
We did. Let's shift gears and give the candidate listening their rapid-fire exam day checklist. What are the 4 absolute must-remember takeaways from sections 67 through 73?
All right, grab your highlighters. Number 1, income tax returns are public records, but inspection requires a specific direct order from the president of the Philippines.
Right. Not just the BIR commissioner and not just a foreign tax treaty request.
Exactly. Number 2, the tripwire. If you are an accountant or lawyer aiding in the formation of a foreign corporation, you must file an information return within 30 days.
And remember, your attorney-client privilege regarding the actual advice you gave remains fully protected.
Number 3, stock dividends are generally tax-exempt, but if those shares are subsequently redeemed or canceled in a way that is essentially equivalent to a taxable cash dividend,
the BIR will pierce the illusion and tax it based on economic substance.
Yep. And finally, number 4, for partnerships subject to corporate tax, their post-tax net income is taxed to the individual partners in the same year it is earned.
Apply the concept of constructive receipt. It does not matter if the cash was actually distributed to the partner or retained by the business.
Keep this checklist front of mind, apply the concept of LIFO for dividends, and you will easily navigate the computational traps they set for you.
We want to thank you for studying with us today on ICPA Review Radio. You are putting in the grueling hours, you are learning the mechanisms behind the rules, and it is going to pay off when you sit for that board exam.
Absolutely.
But before we sign off, I want to leave you with a final thought, pulling from that partnership rule we just broke down.
Okay, let's hear it.
If a partnership's income is taxed to you, the individual partner, before you even get the cash distribution, how does that change the way you would advise a future client?
Ah, that is where tax theory collides with real-world business survival.
Exactly. Imagine sitting across from a business owner who just got hit with a massive tax bill on phantom income they haven't even touched yet.
Yeah.
How do you advise them on managing their personal cash flows just to ensure they have enough liquid cash to pay the government?
It completely changes the dynamic of tax planning.
Right. You aren't just filing historical paperwork anymore. You have to anticipate cash flow shortages before they happen.
It proves that mastering the tax code isn't just about compliance. It's about strategic foresight.
Well said. Keep grinding, keep studying, and remember that every concept you master brings you one step closer to those 3 letters at the end of your name. We'll catch you on the next deep dive.